This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, August 11, 2026, and this is the New York session. Now, let's get into it. Bitcoin is clinging to $64,300, hovering just above a key psychological threshold, while the fear and greed index screams extreme fear at 14. The market cap has barely budged, yet the machinery behind the scenes, the futures markets and institutional flows, has gone conspicuously quiet, setting the stage for a bifurcated battle between speculative bleed and infrastructure survival. Looking ahead, the immediate catalyst horizon centers on two developing narratives rather than hard economic releases. First, the U.S. Senate housing bill is progressing with a specific amendment banning central bank digital currency issuance, a development that alters the regulatory landscape for decentralized assets. Second, Core Scientific faces scrutiny following disappointing fourth-quarter results, raising questions about margin sustainability for miners. Apex, what is the primary lens we should apply to these developments?
We need to view the Senate CBDC ban not as a binary bullish trigger, but as a structural divider. It separates assets that rely on state-backed digital currency frameworks from those built on open, permissionless ledgers. Meanwhile, Core Scientific's stumble serves as a stress test for the operational efficiency narrative in mining, reminding us that even in a downturn, cost discipline dictates survival.
Here is the snapshot as of 9:19 Eastern Time. The global crypto market cap sits at $2.28 trillion, down 0.23%. Bitcoin leads at $64,300, down 1.20%. Ethereum follows at $1,890.09, off 1.60%. But look closer. Link has surged 4.20% to $8.68, while Cardano has shed 5% to 18 cents 72. The VIX rests at 14.90, signaling low volatility in equities, while the fear and greed index is stuck at 14, deep in extreme fear territory. Three headlines are driving this bifurcation. First, Cointelegraph reports Iranian crypto outflows have spiked 700% following U.S.-Israeli airstrikes. Second, CoinDesk notes the U.S. Senate housing bill includes a CBDC ban. Third, Cointelegraph highlights TD Securities seeing NYSE tokenization as an institutional turning point. Pulse: how does the 700% Iranian outflow spike impact the sentiment profile right now? It's creating a ceiling on optimism. Even though the fear and greed index has ticked up slightly from 12 to 14 over the last week, the sheer volume of capital exiting Iran is acting as a psychological dampener. Retail investors are seeing that number and assuming the worst-case scenario for regional stability, which keeps them on the sidelines despite the relatively mild negative price action across the broader market.
And that's exactly why the VIX at 14.90 is dangerous. The market is pricing in a false sense of security because the traditional volatility index isn't reacting to this geopolitical liquidity drain. We are seeing a decoupling where crypto stress is high, but equity complacency is rampant. That 700% outflow isn't just news. It's a tangible reduction in available liquidity that the current price action doesn't fully reflect yet.
Shifting to the regulatory side, the CBDC ban headline suggests a move toward decentralization. CIPHER: how are flows responding to this narrative versus the speculative pain we're seeing elsewhere?
It's fascinating because the flows aren't rushing into general crypto baskets. They are rotating specifically into tokenization infrastructure. Look at Link at $8.68, up 4.20%, and ICP at $2.30, up 3.40%. Meanwhile, high-beta speculative assets like Cardano and Uniswap are bleeding. The money isn't fleeing crypto. It's fleeing the type of crypto that lacks clear utility or regulatory alignment. The CBDC ban narrative reinforces the value of permissionless chains, but the capital is moving fast, not waiting for legislation to pass.
Let's start with the anchor, Bitcoin is trading at $64,300, down 1.20%. Grid, the headline mentions Bitcoin futures demand has fallen to 2024 lows. What does the chart structure look like without that leverage support?
The structure is thin. With Bitcoin at $64,300, we've lost the bid floor that leveraged longs usually provide. The daily candle is pressing against the lower boundary of its recent consolidation range. Without futures backing, every minor sell order from spot participants pushes price down harder. We're looking at a level where the next significant support is essentially untested territory below the 20-day moving average. The lack of volume on the upside means we are drifting lower on weak participation.
And that drift is being exacerbated by the outflows. My data shows that while spot wallets are holding relatively steady, derivative accounts are shedding exposure. The 2024 lows in futures demand mean that when price dips, there are no automatic buy-side stops triggered by leveraged traders trying to catch a bottom. It's a vacuum. The $63,771 mark was the recent low, holding that requires genuine spot absorption, which is currently sparse.
Which brings us back to the geopolitical risk. That 700% spike in Iranian outflows is a wild card that technical charts don't account for. If those funds are being converted to stable coins and exited off exchange, that is dry gas being removed from the fire. It's not a chart pattern. It's a supply shock. The fact that Bitcoin is still near $64,300 is actually surprising given that drain. It suggests the buyers here are highly selective, likely only stepping in for the tokenization plays, not for Bitcoin itself.
So we have a Bitcoin price that seems resilient but fundamentally unsupported by leverage. Let's pivot to the outlier performer. Link is up 4.20% to $8.68, significantly outperforming the broader market. CIPHER, you mentioned earlier this is driven by tokenization news. Walk us through the flow mechanics here.
Absolutely. The inflow into Link is distinct from the rest of the market. We are seeing increased activity around the Oracle networks tied to the NYSE tokenization announcements. Unlike the broad crypto market, which is fighting against the 17% fear index, Link is operating on a separate fundamental axis. Buyers are accumulating at the $8 level, building a base before the broader $8.50 to $9 zone. It's a classic defensive rotation, capital moving from speculative alts into infrastructure that has a direct link to traditional finance integration.
Visually, that makes sense. Link is carving out a separate ascending channel while Bitcoin and Ethereum are consolidating sideways or drifting lower. The relative strength is undeniable. On the daily chart, Link just cleared a minor resistance level at $8, and the volume profile suggests that breakout has some follow-through. However, I'd caution against chasing it too close to 870. There's likely some profit-taking from early adopters right there.
I agree with the caution. From a sentiment standpoint, Link is currently insulated from the extreme fear dominating the rest of the chat. Its community sentiment is bullish because the narrative is strong. But that creates a vulnerability. If the broader market capitulates harder, say, if Bitcoin breaks below 63,771, Link's isolation won't protect it forever. Currently, it's a safe harbor, but safe harbors can sink if the storm gets bad enough. Turning to the laggards, Cardano is down 5% to 18 cents 72, and Uniswap is down 4.1% to $3.86. These are high beta assets suffering in this environment. Grid, what is the technical damage here?
It's severe for Cardano. At 18 cents 72, Cardano is testing the lower bounds of its multi-month range. The decline is accelerating, and there's no visible volume spike indicating capitulation yet. We're seeing a slow bleed. For Uniswap at $3.86, it's holding above its previous lows, but the momentum is clearly broken. Both assets are showing lower highs on intraday timeframes, which is a bearish structure. They are not finding support, they are grinding down.
The flows confirm the abandonment. I'm seeing consistent net outflows from Cardano and Uniswap wallets over the last 48 hours. Holders are reducing position sizes. Contrast this with the inflows into Link and ICP, and it becomes clear that this isn't just a market-wide downturn. It's a sector-specific liquidation. The market is rejecting the community coin and pure decentralized finance governance narratives in favor of institutional rails. If Cardano doesn't reclaim 20 cents soon, we could see a deeper flush toward the 16th cent region.
And let's not forget the regulatory noise surrounding XRP, which is also down 2.8%. While the CBDC ban is theoretically good for privacy and decentralization, the market is currently too risk-averse to reward any asset that isn't generating immediate yield or utility. The fear of additional regulatory crackdowns is keeping capital away from these legacy assets. They are collateral damage in the fight for institutional mindshare.
What about Solana? It's down 1.4% to $75.96. It's a high beta proxy, but it hasn't crashed like Cardano. Grid is their technical support here.
Yes, there is. $75.38 was the recent low, and Solana is holding firmly above that. It's respecting the upper boundary of its short-term Bollinger Band squeeze. The price action is choppy, but it hasn't broken structure. Compared to Cardano's freefall, Solana is showing relative strength. It's likely being used as the beta play for traders who believe the worst of the fear is priced in, but it's walking a tightrope. A break below $75 would invalidate that thesis quickly.
On-chain, Solana's transaction fees are remaining stable, which is a positive sign for network usage despite the price drop. However, the staking deposits are quiet. We aren't seeing new capital committing to lockups at these levels. It's a holding pattern. The capital hasn't left Solana entirely, but it hasn't doubled down either. It's waiting for a clearer signal from Bitcoin.
Let's tie this together. We have a market in extreme fear, yet prices are relatively stable. Apex, connect the dots for us.
The picture is one of forced consolidation. Pulse noted that the fear and greed index rising from 12 to 14 indicates a stabilization of sentiment, but CIPHER pointed out that this is lagging against massive derivative exits. Grid highlighted that Bitcoin is technically thin without futures support, relying on spot holders. Meanwhile, the capital that is active is not buying the whole basket. It is surgically attacking the tokenization sector, as seen in LINK and ICP. The synthesis is that the market is undergoing a structural reset. Speculative beta is being purged to fund institutional infrastructure. The calm in the broader market cap is not peace. It is the eye of the storm before potential liquidity tests.
Key takeaways from today's pre-market analysis. First, Bitcoin is navigating a support level at $64,300 with reduced leverage, making it vulnerable to spot flow shifts. Second, the market is bifurcating sharply, with LINK and ICP capturing institutional attention while Cardano and Uniswap face continued technical pressure. Finally, the geopolitical shock of the 700% Iranian outflow spike remains an unpriced risk variable that could alter liquidity conditions abruptly. Stay tuned for updates as the session progresses. This is ShadowQuant Crypto Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.